Thank you very much indeed, Diane. I guess our title was intended to be a slightly colourful one. It's true, we did not actually sit down and ask 2,500 planners how each one of them formulated retirement income advice, but we did speak to 11 representatives of 11 organisations, and the total number of planners in those organisations exceeded 2,500. What we're going to do today, after a little bit of an introduction, we're going to talk about a number of issues that arise in the context of financial planning. Is my voice sounding like, is there some feedback from the two microphones? All good. Okay, great. So we're going to talk about some issues that arise in the context of financial planning for retirees and pre-retirees. And we're going to talk about them in 3 or 4, maybe 4 groups. So first of all, we'll talk about risk profile questionnaires and asset allocation and the relationship between risk profile questionnaires and asset allocation. Then we'll talk about some broader retirement planning matters. Then we'll talk about the role of projections in statements of advice. And finally, we'll talk about lifetime income products and sort of attitudes to lifetime income products for the time being, and the sorts of changes that could be made to those lifetime products to make them perhaps more desirable. So those 4 headings essentially will be reporting on what has been told to us by our 11 interviewees. And the last 2 dot points there, issues for consideration and conclusion, that's where we sort of sit back. We're no longer talking very specifically about what was said to us. We say, but where we sit back and say, okay, well, what issues does that give rise to? And what conclusions can we draw from those conversations? So, first of all, just to set this in context, the Retirement Incomes Working Group had already conducted a survey of individual financial advisors, and we got about 80-something responses. And we've written a paper summarising, including the detailed numerical analysis. We've summarised the answers that were provided to us by our 85 or something individual retirement planners. But what this is a follow-up questionnaire where we've really taken much the same questions, but we've sat down, we've had the opportunity to follow up in detail with our 11 interviewees. So if there was something we didn't quite understand, we could probe that and understand that a little bit better than we could with the original questionnaire, which was just available online, and our 85 respondents completed the questionnaire online. The objectives of the work that's being conducted by the Retirement Incomes Working Group are 3. Our objectives in presenting to you today are threefold. Firstly, to report on the research that's been conducted by Retirement Incomes Working Group. Secondly, to consider the issues that arise from current planning practices, especially in a retirement incomes context. And thirdly, to consider the role that actuaries might play in terms of contributing towards the future development of the planning profession. Okay, so turning to risk profile questionnaires and asset allocation. The predominant, one thing we can definitely say after our 11 interviews is that the predominant technique for assessing risk profile is the risk profile questionnaire. Although we had suggested a number of other tools, no other tools were mentioned back to us by interviewees as being, oh yes, we use this tool or we use that tool. The risk profile questionnaires were of between 8 and 16 questions. It was at the same time as the risk profile questionnaires were the dominant tool, it wasn't completely exclusive, and it's not the case that 100% of the industry utilises them. For example, one firm which mainly uses risk profile questionnaires permits its senior advisors, in the context where they're already very familiar with their clients, to proceed to recommend an asset allocation without going through a risk profile questionnaire. And perhaps 2 of the most interesting responses were from firms. One firm which does have risk profile questionnaire-like questions as part of its fact find, but instead of just adding up the points and saying, right, well, we recommend X asset allocation, it has a separate question where it asks the client about the proportion of growth assets which the client wants to see in their portfolio. The answer that the client gives doesn't necessarily have to be final, because the advisor can look at the responses to the risk profile questionnaire-like questions, and that can lead to a discussion. And perhaps the most interesting of all was from a firm which actually has moved away from risk profile questionnaires. Their experience with those questionnaires had been an unhappy one, particularly when they'd been taken to task and matters had been resolved by FOS, the Financial Ombudsman. And so instead of having a risk profile questionnaire, they have an online process where there is an educational part of the whole financial planning advice process, which they get the client to complete. So their intention is to give the clients a somewhat better educated approach to coming up with their own view on what their risk profile, on what their asset allocation should be. And at the end of that, they ask the client and they discuss it with the client what the client's asset allocation should be. So in summary, risk profile questionnaire is very dominant, but not 100% across the industry. So nearly all the firms that use risk profile questionnaires have what they call an add up the points approach to mapping from the risk profile questionnaire to asset allocation. So the way that works is there are 8 to 16 questions. They have a certain number of points for each of the maybe 5 answers to those questions, with more points being allocated, for example, to people who look like they're prepared to take on more risk in search of greater return. And then they'll have a point range. So from somebody who is the highest risk, prepared to take the most amount of risk from the risk profile questionnaire, they will map them to a high growth asset allocation. And then there'll be perhaps 4 other categories of assets, like it could be growth, it could be balanced, it could be conservative balanced, and it could be defensive, something like that. So they all have an approach to mapping from the risk profile to the asset allocation. Having said that, I think it was completely clear from our 11 discussion partners that they did not regard that mapping as being, the final asset allocation that necessarily would be recommended to the client. They completely understood that risk profile is a measure of subjective risk tolerance, but that your final asset allocation should be influenced by a number of other factors as well. So, for example, there are 2 points where the advisor would have some opportunity and some input to discuss with the client what risk profile the client wanted, or what asset allocation the client wanted to adopt. So the first opportunity would be, even before even before the advisor necessarily knows the result, after they know the results of the risk profile questionnaire, but before they've done any detailed calculations. Then the advisor might have their general knowledge and experience, and they might use that as a basis for discussion with the client. So, for example, let's say that the client is a 23-year-old, and they're talking about their risk profile, their asset allocation within superannuation. So, and let's just say that the client, for whatever reason, has come out that just psychologically they're very, very, very conservative. So they've been mapped across to a cash asset allocation. So obviously this is a very extreme example. So obviously in that case, the advisor would already be saying, well, look, I can see you hate to see your asset values go down, but you just need to remember that this investment is for, 44 years, 40, whatever it is, 37 years or more. And you'll probably do better in the long run if you're taking more risk than just putting your money into cash. And then the other opportunity for a really serious discussion is after the risk profile questionnaire has been completed, they've mapped it to an asset allocation, let's just say it's conservative balanced, and that asset allocation has been plugged in to the detailed projections that underlie the statement of advice it might become clear that by being in a conservative balanced fund, that the assets are going to run out much more quickly, well before life expectancy. So that's another opportunity for an advisor to sit down and talk to the client and say, look, you're probably going to have a much better chance of meeting your objectives if you're taking more asset risk. One of the things is some advisors may be different from other advisors in terms of their approach to these discussions about asset allocation. For example, there was a suggestion that less experienced advisors might be more inclined to rely on the outcome of the risk profile questionnaire, whereas more experienced advisors might be more willing to lead the client somewhere other than where the add up the points approach has taken them from the risk profile questionnaire. It was clear that all firms impose a certain amount of compliance effort on an advisor who wishes to depart from a risk profile questionnaire asset allocation. And also it was clear that some firms would tend to limit the extent to which advisors might depart from the risk profile questionnaire implied asset allocation. For example, they might make it very difficult for advisors to depart by more than one risk band from the risk profile questionnaire. On the other hand, interviewees generally said that the risk profile questionnaire asset allocation was, quite often it's striking the right asset allocation for that particular client. So often they said reasonably often or frequently or between reasonably often and frequently. So I think the clear conclusion there is that our interviewees see the risk profile questionnaire a lot of the time as producing an appropriate asset allocation, but clearly some of the time producing an inappropriate asset allocation. We asked whether asset allocations changed near retirement, and most respondents said yes, they can and do change over the period prior to retirement, and they cited a whole range of different reasons there. On the other hand, I think about 3 or so of our 11 respondents said that they shouldn't change. And the perspective of those 3 interviewees was, look, at the point of retirement, they've still got a 25 or 30-year investment horizon, so why would they be, significantly changing their asset allocation when they've still got such a long investment horizon? Okay, so touching on some broader matters. Life expectancy. So the people that we interviewed were usually not very familiar with the source of the life expectancy assumptions that was used in statements of advice. So we got a very strong impression that typically life expectancies were coming from the planning software that was being used, which was typically Coin, Xplan or Midwinter. We strongly suspect, although we haven't yet actually confirmed, that generally speaking, people are using Australian life tables 2010 to 2012 with no allowance for mortality improvement. Obviously using Australian life tables, which were prepared about 7 years ago with no allowance for mortality improvement, obviously entails a risk that the life expectancy is going to be underestimated. Spending goals. We discussed whether clients had a good grasp of their spending goals and whether they tended to have a single figure that they would nominate or whether they would specify one figure for wants and another figure for needs. And the message that came back was the grasp that clients had of what they needed to spend really varied hugely from client to client. And also, sometimes clients did distinguish between wants and needs, or more likely what they did was they distinguished between routine expenditure and their irregular requirements, such as for international travel or to replace a car or to pay for a wedding or something like that. As for standards were mentioned, obviously the software always makes the ASFA standards available to the advisors so that they have the ability to work out whether the client could sustain an ASFA comfortable or modest standard of living. And typically, advisors believed that expenses would be higher earlier in retirement when they're buying a caravan or travelling, or they have specific projects, or maybe they're paying for grandchildren's school fees, and lower later when they're physically less able to do things. Well, we asked our interviewees how they determined the sustainable expenditure, and it was clear that they relied on the cash flow projections that they included in the statement of advice. Obviously enough, assets will run out more quickly if the clients are spending at a higher level. And they all said, our interviewees, that the projections allowed for the asset allocation that had been selected by the client and for age pension entitlements and so on. Sometimes there's a mismatch between the client's expected or requested expenditure and the sustainable expenditure, judging from the projections. In that case, there needed to be a conversation between advisor and client about how to resolve that so that the client had ended up with a sustainable expenditure level. The projections that are provided in the statement of advice are almost invariably deterministic, with a single set of assumptions per scenario. Very occasionally, projections allow for declining real spending. I'd say that's quite rare. Sometimes alternative projections would be provided. For example, there might be a central estimate one, and one on an optimistic basis and one on a pessimistic basis. We asked what methodology advisors used for advising clients on drawdown. And the questioning that we used, the wording in the question, did specifically make reference to things like the SIS minimum, safe withdrawal rates, time segmentation approach, bucket strategies, etc. And there was no dominant single response. I think clearly all the firms they probably would all advise the client to the extent that they had money in a superannuation pension environment. Then of course they had to withdraw at least the SIS minimum from those pension accounts. But in general, they said it depended on the client and what the client's requirements were, and really the approach to drawdown could be different from one client to another. There was a suggestion that some advisors do use bucket strategies and like to use bucket strategies, and others actually avoid them for various reasons. So what's covered in SOAs? We asked about all those things, whether you include cash flow projections, non-super assets and income, whether they provide some level of assistance for providing retirement goals and objectives, so spending goals. Risk tolerance, just about always, yeah. Estate planning, tax and social welfare, and generally speaking, the responses coming back were that all of those things were covered in statements of advice. However, sometimes some of those topics might be dealt with a little bit cursorily. For example, estate planning. So often estate planning might be saying, you do or you don't have a will in place, and recommending that you address that aspect of your retirement planning. Whereas other advisors might be experts in estate planning and would proceed to try to work with you to get a good solution for your estate planning. I mentioned that generally there's only one set of projections that's provided in the statement of advice. Quite often, the suggestion was that other projections would be kept on the client's file, but only one included in the statement of advice. At least one firm quotes probabilities of achieving a particular target return over the specified period. And some firms, even though the firm does not mandate or even strongly encourage a stochastic approach, but some of the advisors might adopt that and might have the facilities, sometimes outside the main piece of planning software, to produce Monte Carlo projections, for example. and at least two of the interviewees mentioned engineers and doctors as being challenging clients. In other words, engineers and doctors expected to see not just one thing, because they knew that the world is not a simple deterministic world. They knew that there are a whole range of stochastic influences, and so they would expect their financial planner to be a little bit more sophisticated than to produce a single projection. Quite a few of our discussion partners gave sort of in principle support and approval to the idea of using stochastic methods. But most of the firms, I think all of the firms, do not mandate or encourage them. Some advisors do adopt them. And generally speaking, pretty much a common response from our interviewees was, look, maybe we could do it for advisors, but we're very worried about what would happen if we present that to the client, because we think that will be very difficult for the client to understand or act on. And with that, I'll hand over to David Orford to present the results of our questions in relation to lifetime income products.
Thanks, John. Ooh. It's not moving for me. What am I doing wrong? Oh. There.
That's forward. Yeah.
Got it.
Yep.
Fantastic. Thanks.
Yep.
I've got to say from the start that I'm a bit of a ring hen. The three other authors did most of the work and I came in at the end. But I know a little bit about lifetime income streams, having worked in Canada and elsewhere. Gee, the current perceptions of lifetime income products, only about 1% of retirees take out lifetime income products. And if you looked at that, you'd probably find there people who know they're going to live a long time anyway. I'm glad that some firms do use lifetime annuities, but I think Challenger writes only about $1 billion of lifetime annuities each year, and they're possibly not the real type of lifetime annuities that we're looking for in our society yet, because they have cash returns in them. The single most dominant reason is a low interest rate environment, but also you find that the use of the Australian life tables to evaluate an annuity is probably not giving them full value. So it's not only the low interest rate, but the way that they're evaluated by the advisors. However, those restrictions that have dogged the annuity provision in Australia have been removed from 1 July last year, and so now life insurances and superannuation funds can offer annuities that are far more attractive. The access to funds was a typical requirement of all retirees, but that doesn't necessarily have to come from a lifetime income stream. It can come from an account-based pension that runs alongside a lifetime annuity. I guess the great majority of advisors know the value of lifetime income streams in that they are the only method by which people can reinsure their longevity and thus provide continuity of lifestyle until the point of death. When I did the Diploma of Financial Planning back in the early 2000s, the course was peppered with examples of how to use lifetime income streams. Now that's not there in the current course, but it just showed me that the financial planning world actually saw the value of lifetime income streams. Again, we have the concern for the cost and the value to the client of a lifetime income stream, but the legislation that's come in last year will allow annuities that will be different. They don't have to be capital guaranteed, they can be investment linked. Also, research overseas has shown that people will pay a premium for certainty, certainty being that they will receive an income for the rest of life. So it's something like they're willing to pay an extra 7% provided they're guaranteed that the income will last them for a lifetime, whereas that's not the case with an account-based pension. Research also overseas has shown that people who take a lifetime income stream are far happier, and the last session had a whole section on happiness, if you remember one of the slides, far happier with life because they are guaranteed income for the rest of life, even though that may vary. And people who have Alzheimer's are even happier. I'm glad you're listening. Okay. And of course, everybody wants everything they possibly can and pay the least price for it. So here are the things that people want. Of course, they want an income that's indexed. That's nice, but there's a paper I've read prepared by the World Bank, and it's worth reading. If you're interested, give me a card later and I'll give you the copy of the paper. But the asset liability mismatching risk of providing lifetime income streams that are indexed is severe. Even in Chile, where they have 25-year CPI index securities, there's an asset liability mismatching risk, and the government and the regulators are very aware of it. But of course, we're looking at it from a consumer's point of view, and this is naturally what a consumer wants. Interesting, they want favourable tax, everything they want, but there's a cost for everything. The paper I referred to showed that in other countries where people provide guarantees of various sorts in their annuity products, that the cost of the guarantees was usually understated and the chickens eventually came home to roost in most of these countries. Guarantees have a high cost, and that's proved the death of some of the lifetime income stream products that have been launched in Australia in previous years. Those products are no longer available in this country. That also flavours the attitude of the advisors because they remember those products. John's already mentioned the Australian life tables, and that's how the advisors evaluate them, but they shouldn't really do that. They should use a different mortality, which is one that's relevant to their clients. Getting back to this risk profiling, and they don't assess subjective risk tolerance. They are really a statistical tool, and maybe they only do half of the job. What more can we do? So one of the things that's been suggested is these three things mentioned here, the situational risk tolerance. That's an ASIC thing. That came out of an ASIC study. And what the ASIC's saying is, you might be a certain type of individual, conservative, progressive, or whatever you're described as after doing the test, but your situation of your family that you're looking after might be quite different to that, and that's what should be taken into account, not your particular risk tolerance. It's the situation you and your family are in. The second one is the goal implied risk. In other words, I want an income of 70,000, CPI index for the rest of life, and my wife and my children and all that. Okay, but maybe I don't have enough money to provide that benefit, and I might take a high risk asset allocation strategy to achieve it. Well, you're introducing goal implied risk. The goal is set too high and you're trying very hard to get it, but you're taking a risk to do it. The other is income resilience needs. So people who have lots of assets, they don't worry too much because their income is more than sufficient to provide the income that they need. But the converse, if you don't have that many assets but you have a high expense need, then it's a dangerous situation to be. So that would drive the asset allocation to be more conservative. So are we relying on an imperfect tool by adding up the points method? That we should add some more tools to the advisor's kit bag. Overseas study showed, this is not OECD, I forget where I got it from, one of the research in Europe. Most people underestimate their life expectancy. This is the age 65 people. They underestimate it by about 2 to 3 years. Interestingly, later in life, around about 85, they overestimate. They're not going to live as long as they think. But we've got to use these mortality improvements in all our calculations. We're pricing an annuity, we're going to allow for mortality improvements. We need the consumers, the financial planners, to use those mortality improvements too. And each person, when they buy an annuity lifetime product, they are going to experience those mortality improvements on average for the rest of their lives. You get client-specific factors also that would influence life expectancy. As the last paper presented, there are things that you do in your life that might reduce your life expectancy. And I was reading in the actuary yet last night that there's a thing called genome replacement treatment where you can go in and replace the particular gene that's causing you or increasing your likelihood of having cancer, say. They can remove that cancer. Now, maybe it's not just yet, but it will come, that we'll be able to muck around with our genes and we'll get people to live longer. Hence dangers for the provider of lifetime income stream products. So we've got to make these projections go past life expectancy. Some of the projections that planners did only lasted to life expectation, but they really need to go right to the end of life. So here's an income, what's this doing, John? This is an example of the sort of things that we should be doing, I think, in future to show people, as the last session also showed, we need online calculators so people can see if they do take certain actions, what are they going to get from the age pension and also from their account-based pension, for example. This one is showing the dramatic effect. These are the number of people who die at each age, but it turns out that if you look at age 90, there's 70% of people that are still alive at that time. So we're living longer. This is taking, I think, the improvements in mortality into account. So the death is further out than advisors assumed. People are living longer than advisors assumed. That means whatever they do will understate and provide more income earlier than people have the capacity to pay for. So not only do planners rely on imperfect tools, they haven't got the products at this stage to provide the solutions, and hopefully that will come soon for our country. And we think that stochastic projections are Monty, that just providing one deterministic projection is not sufficient. Even if you've provided 3 projections, you need to educate the clients into using stochastic methods because otherwise it could be misleading. This was a really surprise that advisors leave it to their clients to determine their spending needs. But this is also a great risk because if the client doesn't know what they're spending on, then it is one of the greatest risks because they could be spending 20% more and not really knowing it, and that would really cruel their financial plan. So robust estimates of spending are critical to the success of a plan. Most businesses, most governments budget. Unfortunately, most of us in Australia, even though we might have the education, don't budget. And it seems one of the most important things we should do, particularly post-retirement, as we run out of an income source and we're relying on the assets to generate the income we're going to consume. It was interesting that one firm was going very heavily into education of the consumer, but it needs to be better. We think a better, more informed, more engaged client is likely to make better decisions in their interests. They'll derive greater benefit from the advice, and they're far less likely to come back in the future when things don't work out as they thought they might. So education is key. We think from what we've seen in the surveys, there could be far more education of clients and perhaps even of advisors. And the institute, our institute, could play a role in doing that. You get a range of advisors, and some advisors are really onto lifetime income streams and understand how they're the only product, but others don't. In the US, I'm appalled by the number of advisors that claim that they can develop an asset allocation strategy that will duplicate the benefits provided by a lifetime income stream. In Australia, I'm dealing with some industry funds that tell me the same. They are going to jazz up their investment performance, get better returns and provide income for life. The problem is that the mortality credits in lifetime products are so significant. I think in Guy Thorburns' presentation of the Financial Services Inquiry, he showed that lifetime income products provide 30% more income across life than an account-based pension. So there's a lot of education to come here, and we think the actuarial profession could be of help here in the more technical areas such as the projection bases, the risk analysis, how lifetime products work, and things like the money's worth ratio, which is used in other countries to evaluate the value provided by a lifetime income stream. The money's worth ratio is the present value of the future expected flows out of a particular lifetime product divided by the investment in that product. So in some countries you actually get 1.05, countries like Switzerland. Other countries you'll get Great Britain down to about 90%. So they're saying based on the mortality basis, annuities are providing a good or a bad return to the investor. Okay, the only solution to longevity risk, or I call it the lifestyle risk, because if you've got income, you've got a lifestyle. The changes on 1 July last year will allow a greater range of products. So we have investment-linked products, not capital gain guaranteed products. We don't need to have the costly guaranteed, and therefore the perception of lifetime income streams providing poor value will hopefully evaporate over time. The last point here, the My Retirement products with the covenants in the budget, I think actuaries can help here, but the thing is that this whole market can't start until we have mortality rates. So the Actuaries Institute is working through Rice Warner on a study of mortality rates. But as I've discussed with Guy Thorburn this morning, we're not getting anywhere in Australia, and what we're having to do is to access the CMI data in the UK. So it'll be maybe 2 or 3 weeks away, and hopefully the report from Rice Warner will be available, and we'll be able to start the proceedings and write some lifetime income stream products, whether it's a life company or a super fund that does it. So remember, financial planning is one of the most important things that you will do in your life. It's equivalent to choosing a life partner. It's so important to get things right in the financial planning, everything you do in life, how you invest your money. It will improve the quality of life for all future retirees. And if we get it right, it will reduce the cost of the age pension. Now, we've had some presentations here and it brings in the age pension, but that pension is paid for by us taxpayers, and we'd like to minimise that cost. The way to minimise it is by getting clients to affect lifetime income streams rather than account-based pensions. So, in conclusion, too much reliance on the questionnaires, what should replace them or what we should add to them, such as the 3 aspects that were mentioned in the paper. We need far more than deterministic projections, which can be misleading. So we need to explain to people why stochastic projections, maybe stochastic's a bad word, Monte Carlo would be better, but we need to explain to people how this is done, or new methodology, maybe not sampling from a statistical distribution, but using a past series of investment returns instead, saying if the last 20 years were replayed, this might happen. The 20 years before that, this might happen. But we need something to demonstrate the variability of outcomes. So life expectancy is substantially underestimated, and longevity risk is not currently addressed. So we actuaries can do a lot of things in this area. We can help prepare the educational material, not in all the things, but in the tasks that we're skilled at. We can help with the risk profiling tools, develop more tools, more products. We can work with the licensees of the financial planning practices to work out the gap for the financial planning software. And we can help develop the new products that are coming, the lifetime income streams. Tell you what, I'll leave it there.
Great. Thank you, John. Thank you, David, and welcome, Paul. So we're opening the floor to questions now. We have a short amount of time for questions, so please come up to the mic if you've got a question.
How do I go for time?
Yeah, I'd just like to pick up on the educational idea and how important financial planning is for people, and sort of challenge us. I think as actuaries need to do more than just develop material to take to licensees. I think there's a real opportunity for actuaries to get out there and interface directly with clients and actually deliver the advice and deliver the material. I think my experience is that people like to engage directly with the technician. They're tired of dealing with salespeople. I think there's a real opportunity for us. There's so many people doing actuarial courses now that there's probably a great opportunity to sort of push some of those people out directly to engage the community. So that's probably more a comment than it's...
Do you want to answer that, or do you want me to?
I didn't quite catch that.
Oh, he's making a comment, yeah.
Come on.
Michael?
I'll make a small comment and a question. One comment, I used to run a financial planning firm, and we started looking at psychology-based gamification apps to deal with the issue of the risk planning questionnaire type problem. I'm not sure where it got to in the end, but it looked to be sort of a bit more promising in terms of relatively uneducated people coming to a view as to what their risk, what sort of risk profile they really should have. My question really is coming to some of the things you were talking about, David, with annuities, and one of the concerns we used to have was about the counterparty risk associated with taking out annuities with life companies, and particularly in Australia where we've seen enormous turnover in the ownership of life companies and other issues that with all the major life companies that with contracts and all that kind of stuff in recent times. Have you considered that as part of your research, and if so, how would you answer it?
I think when the annuities were paid to Captain Cook's seamen before they discovered the solution to scurvy, I think the life insurance in those days, the life insurers rued the day they issued annuities. I reckon if you look at the history of the world, the number of life insurers that have gone to the wall because of issuing lifetime annuities would be large. I think they're very dangerous products. The report that I talked to you about, done by the World Bank, it's got all these risks. In most countries, they don't allow for the improvements in mortality. What? They've got massive asset liability mismatching risks. These are dangerous products indeed. When I was actuary at Adriatic Life, I used to send all the agents off to the AMP. They will write the annuities for you. We're not going to write a dangerous product. So I think the financial planners are right to question whether the solvency, and they should have an interest in on what basis is the life insurer issuing this annuity? What are the risks to the life insurer, and are they controlling those risks? For example, life insurance could 100% reinsure mortality risk with one of the world's largest reinsurers. Well, that's spreading the risk of longevity around the world. They could off-source the investment return risk off to the consumer. Well, in that case, they're left with hardly any risk. But I think it's a really good question, and very astute financial planners will ask those questions. And what are the people who evaluate the products? But I think the current breed or the next breed of lifetime annuities will be far more risk-less than the previous, partly because the legislation's changed too, because in the past the capital requirements on lifetime annuities were severe. But now the law, and you've got to give credit to Kelly O'Dwyer here, how many inquiries have we had that have recommended removing the restrictions that prevent the development of a realistic lifetime income stream market? And she did it, or Treasury did it, I guess. But that's great. It provides a new world, not only for life insurers, providing products that aren't capital intensive, but also it's like the same as account-based pensions. You're getting a margin on the assets each year.
From the research perspective, Mike, we didn't look at it. We were only relating what was told to us by the planners, and we were just asked a few questions about the adequacy of current products. But not only from a credit perspective, it's like an enhanced credit with the solvency regime sitting behind that. But the other thing is that you've got a concentration risk as well, and that's also something that some financial planning firms are concerned about, because there's really only one or / two issuers in the market.
We're out of time, so just make it very quick.
Okay, well, okay, I'll be as quick as I can. I I wasn't going to say anything, but you know, I just have to say I couldn't stay still as David talked about the counterparty risk aspect because I disagree with almost everything that he said. If a life company has significant risk, then it needs to hold significant capital, and that is the protection. If there are large asset liability mismatching risks in other parts of the world, you know, we would have to hold a great deal of capital in respect to that. As to allowing new products to exist, which is great, but what makes them capital light is that they leave the risk with the individual. And the problem with those products is a significant mis-selling risk that in 15 years, 20 years' time, people will find out that they bought this thing that they thought was guaranteed when actually it's not. And when the market crashes or longevity extends or whatever happens, they end up with very little. So that the risk exists, somebody needs to bear it, and it is either companies who do face the risk of going insolvent, that is a definite point, but if you don't want to pass that risk on to a company and bear the residual risk of their insolvency, then you bear the direct risk from the start, from dollar one.
Fantastic. I furiously agree with you. I'm with you 100%. Not a problem. Tick.
Yeah.
Okay, well, please join me in thanking Paul, John and David.